Welcome to Behind the Data. I'm Jeff Krimmel, founder of Krimmel Strategy Group. Each week, I take you behind the energy market analysis I'm publishing online. I talk about what surprised me, what I left out, and what I'm still thinking about. Let's get into it. My first post this week was about reading the market. It was a webinar that I delivered on Wednesday called Reading the Market After 6 Weeks of War. And I wanted to use that as a working session to help folks that were interested think through how do we tease out signal from noise in a particularly chaotic market environment like the one we're seeing around the Iran war. And here on the podcast, I won't rehash the session itself. I did write about that on Substack if you want to get more details about what I actually covered and what I described as the signal and how I'm updating my own mental model around a lot of that. But the why I decided to do that was there's such a flurry of information coming at us right now as a result of the war. And it's a perfect time to practice building and refining our mental model of the market. There's really two paths that seem to be particularly attractive for a lot of people. One is to pretend like you have absolute certainty and just explain exactly what's going to happen at this point going forward, why everyone else that is uncertain about this is not being thoughtful or is not aware of all the information that the certain observer has, and communicating with that sort of conviction inevitably enrolls some people in whatever story you happen to tell. It's not a useful framing given how much uncertainty genuinely exists right now. And it seems like the situation evolves based on ongoing developments. There's not a long arc that's driving a lot of the developments in the Iran war. We're seeing rapid changes almost day to day in the state of the conflict, in the state of the diplomatic negotiations. And so there's genuinely profound uncertainty around all of this. The other path, right, rather than pretending as if we have some immense amount of certainty, is just to put our heads in the sand and say that there's no way for us to get in front of any of this. Too much is happening. It's too chaotic. It's too unpredictable. And so I'm not even going to think about it. And we'll just wait until everything gets resolved and handle whatever happens on the back end. And energy executives don't have the luxury of putting their heads in the sand, and the astute energy executives don't pretend that they have certainty that they genuinely don't have and that isn't available to anyone. So knowing the role that energy executives must play right now in the midst of a particularly turbulent, uncertain market, I thought it was a fantastic time to model some of that thinking for anyone that's interested in building a robust mental model around these markets. We just don't get this kind of opportunity that we're navigating through in the market many times in a career, and genuinely it could be just a single handful of times in anyone's career that we might see something quite like this. And so as this conflict has continued on, I've made a commitment to myself that I want to use this as best as I can as a teaching aid to help people that are trying to develop their own fluency, and as a learning aid for myself to experiment and explore with the tools that I have and try to better understand in one of the more extreme market environments that we'll ever come across. How much can we know? What sort of confidence can we develop? What are reasonable predictions to make, reasonable views to hold? How rapidly must we walk back from any measure of conviction based on how things are evolving in the war? So knowing this is such a rare opportunity, I want to make sure that I personally take advantage of it. And it seemed like a great time to host a session on Wednesday, a live webinar, and then write about it afterward and organize my thoughts further and share it on Substack on foundationsofenergy.com. You can go find it there. It seemed like a good time to walk through a lot of that. So that was the big reason why, to go ahead and write that post. We've had 6 weeks of war. There have been a lot of developments. There have been times where it had looked like things might be quick and resolved somewhat painlessly. And there's been plenty of other times where it looks like a long, drawn-out endeavor with second order and third order impacts that could be felt for years into the future. The market is often very optimistic about the resolution here, but there's times when the market responds with what looks like fear or genuine uncertainty around what happens next. So again, we just don't have this opportunity often. I want to take it and use it for get as much value from the exercise of studying it, reflecting on it, and that's what motivated the webinar that I hosted and the Foundations of Energy post that I wrote on the back end of that webinar. The next post that I want to talk about is one that I shared on LinkedIn about why US E&Ps are hesitant to expand their production, even when oil prices are high and have been high for well over a month at this point. And one of the points that I made in that post, and it's something that I've been paying more attention to as the Iran war has gone on, is that while the U.S., Israel, and Iran are at the epicenter of what's happening in the Middle East right now, the longer this has gone on, the less tidy any resolution will be as it relates to the U.S., Israel, and Iran. These other players in the Middle East and around the world are being drawn in, are being impacted by this conflict in countless ways. One point that I made in the post was about the Gulf states in the region, and that even if the U.S. and Iran reach some sort of negotiated agreement that they both find acceptable, there's no guarantee that the Gulf countries find that deal acceptable, particularly, say, if the U.S. and Iran decide to jointly control the Strait of Hormuz. And if the other Gulf nations feel like it's just unacceptable, that we're going to have to pay some sort of tolls, or we're going to have to add on some element of negotiation to navigate through the strait in a way that we've not had to in the past, they may find that unacceptable, and they will have a vote in what happens on the other side of any negotiated agreement between the U.S. and Israel and Iran. The longer the war goes on, in my mind, the more the greater the probability that some sort of complication like that emerges and meaningfully impacts how we should think through what happens on the other side of an agreement. That was the main reason why I wanted to write that post, is that the news rightfully is dominated by the U.S. and Iran in particular, and it, I believe, underplays the stake that many other countries have in whatever the resolution is. And while the U.S. and Iran may both be greatly fatigued by all the active military combat that's occurred, these other nations are not fatigued in the same way. They are fatigued in different ways. And I think it's really difficult to predict how the region, how the world would respond to any of a number of potentially negotiated agreements that the U.S. and Iran may come to. It's that thought that really motivated this post here, because one of the reasons that the US E&Ps don't want to go aggressively expand their own production is that there are scenarios where the U.S. and Iran can come up with a negotiated agreement at a moment's notice. And we already saw earlier this week that when it was thought that the Strait of Hormuz might be fully open again, oil prices dropped all the way down to near $80 for U.S. oil prices, which is still quite a bit higher than oil prices were before the war began. But $80 is nowhere near $100. And so it's a reminder of how difficult it is for US E&Ps to formulate a view of what will happen to oil and gas prices going forward and adjust their capital programs to the extent that they want to adjust their capital programs around that. So that idea of the complexity of understanding what happens on the other side of a negotiated agreement that ends active conflict. I wanted to write about that. That was the big motivation for that particular post on LinkedIn this week. The next thing that I wrote about that I want to talk about is BP's announcement about having changed their reporting segments. And they're now moving down to a very simple upstream and downstream pair of reporting segments. They're moving away from, say, a low carbon energy reporting segment that they had previously. So why did I write about that post? And some of it is just very selfish. I am genuinely fascinated by how businesses choose to study and report their own performance. There's effectively countless ways any business could organize its performance, organize its segment, and allocate their costs and the revenues between those segments so they can better understand what is actually moving the needle within their businesses and what levers they may want to pull to optimize the performance of their business as a result. We get a very different story, different visibility based on what decisions any management team makes regarding their reporting segment structure. In the case of BP, you have the really interesting component of the company having bet so heavily in favor of renewables and the low carbon element generally, and just has not to this point captured the returns off of that are anywhere close to what they've captured consistently from their oil and gas business. And so now when you revert back to this upstream, downstream component, it's one of the more visible elements of the extent to which BP is fully embracing its oil and gas business and trying to articulate back to investors about how serious they are in dedicating themselves to oil and gas. So eliminating a low carbon segment entirely is one more step they're trying to take to prove that they are fully committed to this hydrocarbon reality and this hydrocarbon future for themselves. It's also a demonstration that there's profitability, expanded profitability that new BP leadership believes can be found within the hydrocarbon business. When you organize your business between upstream and downstream, necessarily that creates more focus in those areas. So now say there is no lead of a low carbon business that sits at the level of upstream or downstream that is arguing for capital within a broader capital allocation endeavor. And so you just have an upstream, you just have a downstream component in terms of your reportable segments. It's not exactly clear, what the new leadership team at BP, how that will be reorganized. In principle, you typically organize your leadership team in a way that creates as little friction relative to your reporting structure as possible. It's not ideal to have an organizational structure that actively conflicts with your reporting structure because it just creates more expense and difficulty in crafting the financials around these segments. And then when you talk about the segments on an earnings call, say, if your leadership team doesn't align around those segments well, it's tougher to find people that can capably speak to the more granular performance within those various reporting segments. So I expect that the organizational structure will evolve in a way that supports this upstream versus downstream segment structure. And as a result, we will get a different commentary, we will get different visibility, we will get a different perspective out of BP simply because they are measuring and reporting on their business in a different way going forward. And that is something I'm genuinely fascinated about. Every business has to make that decision about how they'll organize their business. One of the things I wrote about in the post was the valuation for we can say any publicly traded business, but really for any business, when you distill it sort of at its highest level, the valuation is what earnings the business generates today times what multiple that you would apply to today's earnings. And the multiple is the way that you cast today's earnings into some view of how you expect those earnings to evolve going forward. So if you expect earnings to be more robust for one company than another, and they've both generated the same dollar amount this year in earnings, the one that you expect to generate more earnings in the future will have a higher multiple. And so when you have a low carbon energy segment, you're typically trying to make an argument around multiples. You're trying to say, look, we have in principle the same profit dollars that another oil and gas company might have, but we feel confident that if you know that some of those earnings dollars are coming via a low carbon energy segment, then you will imagine that segment is more robust. You will apply a higher multiple to that segment. And as a result, our whole enterprise valuation goes up. Now, the new leadership is saying, no, that's not the case. Either they don't believe that investors will apply higher multiples to low-carbon energy businesses, or even if they think, in principle, a higher multiple would be available via the low-carbon business, having a separate low-carbon segment distracts from the hydrocarbon segments that are generating a larger volume of earnings dollars. So when you switch to downstream and upstream segments, you're now punting on this low-carbon energy segment. So you're no longer giving investors the same visibility into where your earnings are coming from and allowing them to assign different multiples in different ways. But you are saying that we are confident there are more profit dollars to be had within oil and gas if we organize around upstream and downstream and then have laser focus around expanding our profitability in that domain. So this is BP, instead of trying to make an argument to investors around what multiples to apply to different earnings streams within the company, this is BP saying, our existing earnings stream is not optimized, and we'll go optimize that. And we are fine foregoing some multiple advantage that we might get by carving out low carbon energy because we feel more confident that we're going to capture more earnings with this focus on upstream versus downstream. So the broader conversation about reporting structures is just something I pay a ton of attention to, fascinated by. This BP news from this week is one of the more visible demonstrations of the thought that goes into designing reporting structures and the possible implications of making a change in reporting structures. The last item I wanted to talk about was a post that I wrote about Norway's record crude exports. And I wrote that post because it is very easy for energy analysts to dunk on European energy policy, just like they dunk on California energy policy. And I understand why a lot of analysts are so vocal about the extent to which Europe and California are both turning away from hydrocarbons, even though they rely heavily on hydrocarbons today. And when you turn away from domestic production of hydrocarbons, you're necessarily embracing imported hydrocarbons. And imported hydrocarbons come with security risk, added environmental risk, possibly price risk that you no longer control in the same way that you would if you had a domestic hydrocarbon production footprint. So it's easy to dunk on those two. To be perfectly frank, I often find that dunking to be too gleeful and not sufficiently substantive to really warrant all the coverage. It just seems like people wanting to take victory laps. They're celebrating the role that hydrocarbons are playing in the energy system. And so it's easy to poke at Europe and California over what's happening there. The reason I wanted to write the post about Norway, though, is it reveals something about European energy policy specifically, implicitly about California's energy policy, that both of those energy policies are much more complex than they're often given credit for publicly, right? When you have the two extremes of the energy conversation talking, you have the oil and gas side dunking on Europe and California. You have the renewable side making strong moral arguments in favor of what Europe and California are trying to accomplish. But the reality, the pragmatism of their energy policy choices and the different effects that result from those decisions are often lost in the more evangelized tribal element of the conversation around Europe and California. So the Norway post that I wrote was more about how Europe does have these sources of domestic hydrocarbon production. And they're at an interesting point where they're relying heavily on whatever hydrocarbons are produced in the region. And yet, right, there's this narrative that Europeans broadly would prefer to have about pivoting away from oil and gas as aggressively as they can, embracing clean energy technologies, again, as aggressively as they reasonably can, and leading the world in that direction. And right now we see a point where energy security matters so much and so much more, is just so much more visible than it has been recently, that the Norway windfall really throws some light on this in a way that we don't often get when we read the broader energy analysis. So it's an area that I wanted to pay attention to because I don't linger a whole lot on Europe and California, again, because they're so widely discussed and the conversation becomes so emotional and so politically embedded that it's just not an area that I find particularly productive to engage in, except when we get something like this, where you have Norway that's generating windfalls from their crude exports. They're using the royalties they're generating to feed their sovereign wealth fund and improving the lives of Norwegians today and for generations into the future. And that's coming in this area with this very interesting tension between the role of hydrocarbons in the European energy mix and the wish that Europe has for itself and how it wants its energy mix to evolve in the future. So that's why I wrote that post. As always, thank you so much for listening to the podcast. I have a new oil and gas market mastery cohort that launches on Thursday. If you're interested in developing your own executive level market fluency and you want to do it with a cohort of peers that are taking this as seriously as you are, I recommend you check it out. You can find more information at crimelsg.com/OGMM. Thanks a bunch for listening, and I will see you next time.